I will answer that in more from a sector standpoint, but this is also applies to investment opportunities. The retail sector has been performing better than I anticipated. During COVID, clearly the retailer in the sector was heavily impacted. A lot of tenants elected not to pay rent, a lot of rent deferrals. So there was a feeling that that would continue in a very negative trajectory post-COVID, but really the reverse has happened where retail performance, less bankruptcies have occurred, tenants' health has been much better, even certain sectors such as food and beverage, entertainment, theaters are now back in a positive way. So I'd say the retail sector has been, the performance of the retail sector has been one of the more pleasant surprises of late for us. And I think if you canvass most institutional investors, their retail portfolios are all fairly well leased and doing well. The second sector that has been a pleasant surprise of late, similar to the retail sector, the urban apartment subset that was heavily impacted from the pandemic. As everyone knows, many folks left the urban areas, and so markets like New York, Chicago, San Francisco, those housing assets, particularly the more luxury ones, were not doing well and were offering, in some cases, 3 months free in concessions. That has rebounded very, very nicely, and our New York housing assets are charging rents now at pre-pandemic levels. So those are two areas that I would say have been pleasant surprises and may have exceeded expectations compared to some of the sectors such as industrial and maybe Southeast multifamily that have always been doing well, but people expected them to do well. Those two sectors are maybe beating expectations.